Good morning, everyone. It's great that you've joined us today. Welcome to our first panel of our Moscow conference. We called it Russia's Economic Resilience, Previous Efforts Are Paying Off, and it is devoted to macroeconomic outlook and macroeconomic policies that are as important as ever, or probably more important than ever during this challenging year. Today with us, two great speakers, two excellent economists and policymakers, Alexey Zabotkin, Deputy Governor of the Central Bank of Russia, and Alexey Moiseev, Deputy Minister of Finance of Russia. Alexey Moiseev has more than 20 years of outstanding track record in both financial industry and government administration. Alexey holds the office in the Ministry of Finance since 2012. And Alexey Zabotkin, after more than 15 years of impressive career in financial markets, he joined Central Bank to lead monetary policy strategy and implementation. Alexey Borisovich, Alexey Vladimirovich, thank you so much for joining us today and finding time into your tough schedule. We are here today together with Charlie Robertson, our global chief economist, to question you on your outlook on Russia economy and policy changes and responses. We are bringing together past, present, and the future to focus on a more longer-term perspective. As Charlie and Dan mentioned today in their opening speech, Russian market seems to be quite resilient to global turmoil, and this is partially thanks to an impressive effort that was made by the government and the central bank in a stabilisation policy in recent years. And throughout this quite testing year, where are we heading to? Is the policy agenda evolving? And just before we start our discussion, dear participants, some technical details for you. If you would like to ask a question to our panelists, please send them to us in the comment box in the right part of the screen next to the video player on your streaming page. We will have a brief Q&A session in the final part of our panel. And now I will give floor to Charlie Robertson to launch our discussion. Charlie, please.
Thanks very much, Sofia. And if anyone hasn't already worked this out, Sofia is the brains behind our macro views and all the best work we're doing out of Russia, I think, on the macro strategy side. So all the difficult questions, please, to Sofia or to our policymaker guests and none to me. Right, I'll promise to speak more slowly for the translators. I'd like to kick off with Alexey Zabotkin from the Central Bank. We put out a piece last week saying maybe emerging market interest rates are going to go to zero, as they have done in Europe and America. And within 24 hours, Russia cuts 100 basis points off interest rates, which I was delighted to see. So thank you for the good cooperation between Renaissance Capital Research and the Central Bank. More seriously, what was going on? Why have we seen such a big cut? It would be very helpful, I think, Alexey, if you could perhaps talk us through what the central bank's thinking is, where are we going on rates? If you could do that for maybe 3 to 5 minutes, and then we'll either jump over to Alexey Moiseev if he's joined at that point, or perhaps then pursue some more questions. But if I can hand the floor to you for a few minutes introduction, please. Thank you.
Thank you, Charlie. Thank you, Sofia. Thanks for having me. Probably it will be more 5 minutes rather than 3 minutes. And to be fair, actually, the 100 basis point cut was telegraphed well in advance by the governor, more or less since mid-May. So probably I can say that RenCap took a cue from those hints. But definitely 4.5 is still very far from zero, and actually, in our view, kind of zero is not within reach, within a reasonable range of the scenarios. Onto the scenarios, probably I'll walk you through the current thinking and the as kind of it stems from the central bank's forecasts. Starting with growth, the forecast which was released after the April board meeting stands at 4-6% decline in 2020. That is a somewhat wider range than we usually use, but we think that it's totally justified given the magnitude of the uncertainties about the parameters of the future. We since April the things which probably influence the forecast and which will be impacting the update of the forecast in July are on the one hand, the extension of the restrictive measures both in Russia and elsewhere. Beyond April, kind of they lasted more or less since mid-June, which will subtract some sizably from the second quarter GDP number. At the same time, we had two more packages of fiscal measures announced in late April and then in early May. So the overall fiscal thrust for this year will be more pronounced, and that probably still keeps us comfortable with 4 to 6% range as the baseline for now. We see subsequent recovery at 2.8, 4.8 in 2021, and the economy will converge to the level of the real GDP of year 2019 sometime in the first half of 22. There is a major uncertainty about impact of the events of the first half of this year on the potential GDP path. Most of the current drop we currently interpret as the negative output gap, and that obviously creates the rather significant disinflationary pressure in the economy. Nevertheless, we pencil in some modest drawdown to the potential already in the second quarter 2020, and then it stands through the forecast period partly as the recognition of the OPEC plus arrangements, which will last, as we know, until more or less first of quarter 2022, and then also partially as the reflection of the impact of high uncertainty and higher marginal costs stemming from the pandemic and the actions of the government on the businesses. So overall, I think the path of the baseline path for the potential is somewhat lower than the one we assumed back in February, but it's smaller. That revision is smaller compared to the magnitude of the negative output gap. But if there is a more significant scarring for the economy, and that is particularly could be the case if the risk of the second pandemic wave materializes, then it would imply less negative output gap and faster convergence to the potential, and thus it will imply lesser disinflation through the forecast period. But that's we are speaking about the outlook for 21-22 first and foremost. On the monetary conditions, these tightened in March, April, as in many other places in the world, amidst external volatility and introduction of the restrictive measures by the government. They're getting better now. We know that the yield curve is lower than it was back in February, and actually at the lowest point in the modern Russian history, I would say. And that all transmits into the corporate bond yields. We think that the transmission into the lending rates and lending conditions will take somewhat longer time, not least because of the period of the restrictive measures. But overall, we believe that the overall transmission mechanism remains pretty much unchanged, and we see the 3 to 6 quarters lag as the horizon for the monetary policy actions to actually fully transmit into the real economy and into the inflation path. Onto the inflation, to put it mildly with the British understatement, the developments of March, May were quite heterogeneous, both cross-sectionally and time-wise, but by now we're probably beyond this kind of period of short-term deviation of inflation upwards because of the transitory factors. Among those were, of course, the depreciation of the currency and also the dislocations between the demand and supply in certain in certain products and services. The board's sense last week was that the inflation numbers for May and first half of June, to the extent we are able to decipher them from the details of the statistics, the headline inflation is running close to or slightly below the 4% annualized rate on the seasonal adjusted basis, and we see further disinflation and the decline of the run rate of inflation below 4% in the second half of this year. And as we stated in the press release, without in the absence of the further monetary policy accommodation, there is a tangible risk of lasting deviation of inflation below target in the year 2021. And that takes us to the monetary policy decision. That is why the 100 basis point cut in our view is totally justified. And again, it's part of it's sort of the logical continuation of the forecast revision, which was made in April. Timing-wise, we were more comfortable to do it now than back in April because of the kind of moderated financial stability risks and the external volatility, and also because of the larger drag from the demand and net given the great extension of the restrictive actions. The message of the board is that it still sees some further room for monetary accommodation. However, it will kind of judge the appropriateness of this accommodation based on the incoming information and the upcoming meetings. With this, I will probably conclude. It was a bit more than 5 minutes, and or back to Charlie.
No, thank you very much. I do want to come back with some questions, but I'm also keen to hear the view of the finance ministry as well. Alexey Moiseev, I believe you've now joined us on the call after a couple of minutes delay. Assuming you are on, I'd like to hand over to you to get a similar few minutes overview of where you see the economy going over the next 12 to 18 months, or what the government's role is in trying to support what's been a hell of a shock for everyone, me included. So if I could give the floor to you, Deputy Finance Minister Moiseev.
Yes, thank you very much, Charlie, and thanks, Alexey. Glad to see you. It's been a while since we saw each other. Thanks to your Renaissance for giving us a chance to see each other. Let me take on from what Alexey has said. Of course, we were listening very carefully to what the central bank has said on Friday, and this was reiterated by Alexey's comments. And in fact, this is very encouraging that the central bank is looking at potential further easing of the policy, because we are afraid that we might deliver the deflationary shock going forward from the fiscal side. We are currently envisaging that we are back into the fiscal rule by 2022. So a lot of measures are pulled back now. Some measures are pulled back in November, such as the mortgage market support, and other measures will also be pulled back over time. So we are not going to live without the fiscal rule for a long while. We fully intend to go back to the fiscal rule by 2022. And this means, of course, that the fiscal policy will deliver, as I mentioned, the deflationary effect on the economy. So it looks like we are changing sides, and as far as we're concerned, this is a very good news.
I guess from my perspective, what's been striking to me and a global theme has been this idea of a savings glut driving down inflation globally. We get another deflationary shock from this coronavirus. Inflation does seem to be coming in low, as the central bank's already suggested. And I wonder what's to stop inflation going to 0 to 2% over the next few years. It feels like the finance ministry is going to be very careful, as it always has been. So I'm just trying to work out, where's the inflation going to come from in Russia on the medium term?
I'm very old-fashioned, right? But I'm a very strong believer in the maxims proposed by Mr. Friedman back in the 70s, or probably even in the 60s, right? That inflation always and everywhere is the monetary phenomenon, right? The inflation will always happen if the money supply growth is happening, right? And I think that if we go from that basics, right, that the central bank is in the position to engineer whatever inflation it thinks appropriate. And which it is mandated to deliver. So I think that the monetary policy of the Bank of Russia will be calibrated to the 4% inflation target. And based on our forecast of the economy and its position with respect to the potential and the parameters of other things, including the fiscal policy, right? The fiscal policy kind of after it consolidates, after this period of consolidation is over, will be again neutral starting from year 22. Or kind of from late 22, right? And and I think that otherwise it's all about the interaction between the GDP, its potential, and the inflation expectations, right? And it's fair to say that the inflation expectations are lower now, and whether they are above, at, or below our target, we probably are yet to see. So far, it's our assumption was that inflation expectations are still somewhat above the target, but again, the developments of this year may alter that assessment.
Thank you for your comment. Thank you for your comment. And what do you think in this context? We don't have any probability to see the revision of the central bank target for coming years. So it seems like that if we face like very low global inflation environment, then probably we just will wait to see additional easing or more prolonged easing from the side of the central bank.
I think that it will depend on the configuration of other factors, and it's wrong to assume that the global inflation and the domestic inflation differential actually amounts to the structural easing of the domestic monetary policy, right? At the end of the day, it is about the relationship between the output gap and the gap on the inflation expectation, right? And if the inflation expectations for Russia are at our target, then there is and the output is at potential, then there is absolutely no need for the policy to be structurally easy. The problem with the Western world is that the banks there, the central banks there, were not able to actually deliver on their targets. They slipped below them, and that had the reasons why it happened. It's a matter for a very long, separate conversation. But I think that it shall not be the experience which is extrapolated on the world as a whole.
I know that I had this conversation with the Central Bank of Israel back in 2003, and we were talking about the potential for them to create inflation. And I remember the conversation ended with, but of course, any central bank can always create inflation. And I agreed. At the time, I agreed. But having watched the last 10 years or so of developed markets, I'm less and less sure. So I'm going to be on the dovish side of this debate, I think, for the next few years. Sofia, I know you wanted to ask some more questions as well.
Yeah, I think my question is for both our speakers today. Surprisingly, in course of this very crisis, a high share of the state sector in the economy became a good news rather than a point for criticism, just because it tended to decrease costs of the pandemic in terms of employment or fiscal adjustment. And as a result of this sizable fiscal stimulus that we see across the globe, it seems that footprint of the government into economy will increase across both developed market and emerging market. So what do you see as a desirable path for Russia in this context, in terms of the scale of the budget to GDP or state share in the banking sector and credit? And what about plans on privatization?
Let me begin here. Well, as you may know, the Federal Property Agency was recently transferred into the hands of the Ministry of Finance, and it's my now it's my responsibility to deal with it. And of course, the answer is twofold. One is yes, we are fully intent to continue to conduct privatization as rapidly as we can. In fact, I was convinced in February. I was convinced that we finally do sell a quarter of Software float, which we were planning to do for 20 years almost. In fact, more than 20 years, and we would have done it. I'm convinced had coronavirus not shut the market. So we will be back into this paradigm, and I'm sure that we will keep on the privatization as soon as markets open. In fact, I hope that there will be deals coming as early as in fall of this year. At least we are working on a couple of deals now. Unfortunately, I cannot announce that because there will be, otherwise I will be charged by the central bank for sharing inside information. The other thing is we're looking currently at how we manage the state companies. We feel that we need to trust more to the boards of directors, that we have overloaded companies with government so-called directives, which make and regulate every step of the corporates, and which preclude them from being competitive in the out markets. In fact, this is a shift of the pendulum, because at some point we felt that we need to issue those things in order to establish proper corporate governance standards in state-owned companies. Now we see that those standards are well established, and in fact, I see that in government-owned companies we actually enjoy better corporate governance standards than in many of the private companies, because that's been the policy from the government that we've been pushing and pursuing. However, now we feel that the boards are well established in most companies, and we can step back. And what we're going to, what we've been proposing now is basically chop a large number of government instructions on how to manage those companies. In fact, we feel that the government companies are companies and corporations, and as such, they should extract profits and pay dividends to their shareholders. And if the government wants them to do something, the government should pay for it. So that's the main baseline policy which we are going to pursue. And furthermore, we want to change the way we structure the KPI for the management, so that 3/4 or at least 2/3 of the weights are exclusively economic weights, such as return on assets, return on equity, ROIC, dividends, and total shareholder return, and various other indicators which first and foremost show how companies cater to their shareholders. So even if we are not likely to see government exiting or reducing below 50% from many companies very soon, we're definitely going to steer them in terms of how the government manages its stake into proper shareholder catering from them being former Soviet ministries developing various industries.
Thank you, Alexey.
I just wanted to jump in. Oh, sorry. Alexey Zabotkin, you wanted to say something.
If you permit me to jump in for 15 seconds, I think kind of coming back to Sophia's question, in terms of the size of the government as measured by the size of the budget, right? Given that the budget rule is still in place, and we are converging to it back in by 2022 at the latest, there is no structural increase in the size of the government. That's kind of how you should think about it.
Fair enough. That issue of dividend payments that Alexey Moiseev was talking about has been tremendously popular with the clients, with our investors. Foreign investors recognize that as a huge shift in Russia. It's incentivized, we think, better behavior on the part of management, more efficient management, and good news for the economy. One issue that's come up in the last couple of weeks with investors is about the issue of US sanctions again. And I'm almost loath to talk about it because we've talked about it so much over 6 years. But my base view is that US presidents do not get re-elected if there's a recession in their first term. That suggests Biden wins this November. And already we've got bond clients saying that this is going to impact their thinking on Russia later this year. What can the central bank do about it? Are you concerned that the $43 billion worth of foreign money in the local debt market, some of it may leave? Is there anything the finance ministry will... I saw a hint the other day that you might well issue a Eurobond on the European markets, if not in the dollar markets. I'm just curious about how you think about this potential risk. And it's speculative, it's 6 months ahead, 5 months ahead, and who knows who's going to win the election. But I'm just curious about what your scenario planning is, because I know our investors want to be aware of the what if scenario. And by the way, anyone's got questions, you can put them onto the Zoom chat and we will try and make sure that we ask them before the session is over in less than 30 minutes. Okay. So take it away, Alexey, which is
I'll speak on that pointed question, but frankly speaking, as we said always, right? We of course have done all the homework regarding the contingency planning. A lot of that work has been done back in 2018 when the previous round of the sanctions anxiety materialized. In terms of the central bank's response to these contingencies, they will play it by the year and deploy whatever measures are required to attain the inflation target of 4%, subject to maintenance of financial stability. I think it's a pretty much boilerplate answer, but that's what it is.
Mr. Moiseev.
Yes, let me throw my 5 topics, not cents. I do remember very well the 2014 when it was a big shock to us that things like sanctions can possibly happen. Of course, we have always felt and continue to feel that this is completely uncivilized behavior, but there's nothing we can do about it. You have something which is coming upon you, and that's externality which we have to be prepared for. And that's one of the reasons why we are wanting to go back into the limits of the fiscal rule as early as reasonably practicable, which we feel is going to be in 2022. But secondly, given completely unpredictable steps which we can go forward, we of course need to protect the financial system from infrastructural sanctions. And that's exactly what we've been working on. And that's also one of things I was spending a lot of time on. Things where central bank has been a good partner and many areas lead. Things related to independent settlement systems with our major trading partners, with the shift into the settlements in local currencies, that financial information transaction systems which are independent from a national system that can switch us off, and so on and so forth. And that's exactly what we need to do. Basically, we need to make sure that financial lifelines continue to work, which is exactly what we've been working on for the last 6 years. We will continue to work on that. I'm not going to Charlie to give any hints on possible Eurobond issues again. That's going to be an insight from my side. You'll hear it in due course. Again, we will continue to build domestic market base. In fact, I was just going to ask if I might leave to another call with the Parliament, where we're going to discuss a law on qualified and unqualified investors. And that's one thing we want to build, is to make sure that more and more Russian citizens enter the financial market, so that we can rely more on domestic investors when we sell our bonds. And in fact, An important measure to that extent was taken this year when we started taxing deposits and interest on deposits. That has never been the case, and this was a tremendous detrimental impact on development on the financial markets, given that people were disproportionately motivated to keep money deposits. Now that's going to change. And in fact, the only tax-free option for people to invest their personal money is the so-called individual investment account, which severely limits the amount of money which is placed in the money market. So people have to keep money there in bonds or stocks. So we will develop that as much as we can and see what happens. The last thing I want to do is forecast the U.S. election process, because if I do that, I'll be charged on indirect interference in the U.S. political situation and consequences. So I'm sorry, I really need to leave for another call. Unfortunately, I was told that there's a call with the State Duma. So thank you very much, and unfortunately, I have to leave. I'm sorry.
Thank you very much for being able to attend for this time. And I know, Mr. Zabotkin, you also need to leave at about 11:15 Moscow time. So we've got about 10 minutes left to run. So I was going to ask both of you actually about the credit rating outlook, but perhaps that's not so much the central bank's area. It's just that 2 months ago, I thought everyone would get downgraded. And Sofia said everyone, but not Russia. And I was just wondering what the view of the central bank is on that. Have the rating agencies been talking to you over the last month or two?
No, I think that's not a secret. Of course, they were as a part of their regular rating reviews. And yeah, so far the conversation was very conventional.
Very good. Sofia, over to you with a couple more questions.
Okay, it's really tough to focus just only on the central bank questions, just because we still have probably some issues left for Ministry of Finance. So probably just making it in a combination. So your view on the effect of possible changes on, longer perspective outlook for commodity markets. During these couple of recent months, we saw oil prices at unprecedentedly low levels, and now the recovery of price dynamics is supported by the cut of supply, which makes it quite a fragile balance. And it seems like low oil prices, low fuel commodity prices dynamics seems to be like a more realistic scenario for a longer term perspective. And what is your view, how it could influence your decision making, how it could influence real exchange rate and thus affect interest rate decisions?
With respect to the exchange rate, we have abolished the practice of commenting on the exchange rate quite a few years ago, before I joined the central bank. So I won't elaborate on that. But in terms of the thinking on the longer term commodity price dynamic and specifically oil price dynamic, I think we actually historically subscribe to a fairly conservative view, right? Even as the oil prices stood at $60-70 per barrel, our long-term assumption in the medium-term forecast was the convergence of those prices kind of towards the long-term level, which oscillated between 50 and 55. Right now, it is at 50, and that's what is baked into the forecasts penciled in back in April. So the forecast for 22 is 45, but actually by the fourth quarter of 22, it gets to 50 in nominal terms, right? So in real terms, it's less than that. In our view, that opinion is still quite balanced. Assuming there is no dramatic drop in the global GDP potential path, But the answer is that it's all part of that discussion about the global potential, right? But ironically, the smaller is the potential, the faster is the convergence to it, right? So within that logic, actually the disinflation will be less pronounced if the larger proportion of the current downturn is attributed to the potential rather than to the output.
If I could, there's a question's come in which is related to this, actually. It's to do with wages outlook. And I guess it's equity investors curious about the potential consumption rise in Russia in the next few years. What's the view on real wages growth? You've got fairly full employment in Russia, quite low unemployment, going past, looking through the coronavirus. And then potentially there's that whole mortgage boom story of cheaper interest rates driving up housing finance and people investing more in housing, like we saw in Central Europe, the Baltic states, Estonia, and so on 10, 15 years ago. So I'm just curious, what's the outlook for real wages growth and consumption on a 3 to 5 year view, if you have thoughts on that?
I think, again, we will know better, I think, in a year's time when we know better the new steady state for the economy, or we can judge better the new steady state for the economy. But as we know from the recent past, the wage growth in real terms progressed at about 2-3% a year, right? There was some decline in first half last year because of the inflation spike caused by the VAT introduction, right? But overall, the real wage growth in 2-3% range in real terms is what apparently seems to be fairly close to the medium-term trend, right? And assuming there is no dramatic changes in the structure of the labor market, that's what it is going to be. But the thing to keep in mind is that this is happening against the backdrop of the declining labor force and declining number of workers, right? So the total wage bill is actually rising less than that, right? And the total growth in the disposable incomes, as we've seen, it was pretty much stagnant for the past 4 years, right? It started to get more positive in the second half of last year, but overall the disposable incomes will be lagging real average wages because the labor force, the number of labor force and the number of jobs is shrinking and will continue to do so until probably year 22, 23, or maybe even 24. And then the second factor is, of course, the fact that part of the disposable wages are only part of the disposable income. There are other components which have been kind of behaving less robustly than wages. But overall, I think that in terms of the income levels, the dramatic acceleration of the disposable incomes is probably not in the cards for our forecast horizon. So there would
fair enough. 2 to 3%, I think, is probably what most people are looking for, and it's a little bit better than blue collar workers have had in the States for a long time. What about the risks of excessive credit growth? I've always been on the more bullish side of this, feeling that Russia could take some risks and allow credit growth to pick up very fast. Because mortgages are, still 4% of GDP or so? It feels like there could be 100% growth and then 100% growth again. And still, the mortgage market would be quite small compared to other countries. But I've been struck by how officials in Moscow have always been very careful about this. And when they saw unsecured lending picking up too strongly earlier in the decade, measures were taken to control that. What's the central bank's thinking on it now? Would you be very upset by 40% credit growth? Are you okay with 20% consumer credit growth or mortgage growth? What sort of numbers would concern you versus you can be relaxed?
Okay, I think the answer to the direct answer to this is that we are not targeting credit aggregates. We are targeting the inflation, right? And the credit growth will be endogenously decided by the outcomes, which are consistent with 4% inflation target or our efforts to obtain it, right? Kind of with that respect, and then there is a separate matter of the financial stability, and that is what informed certain regulatory actions which were taken starting from late 2018, actually, to lean against and what we judged was an excessive growth in the unsecured consumer lending, and we think that that position was justified. Again, it was driven by the kind of financial stability considerations related to the individual segments of the market, not a system as a whole. And we will continue to employ these actions, not least in order to protect the customers, the population from the excessive borrowing. Because I guess that's one of the excessive load. That load is one of the reasons why the Western central banks cannot hit their target.
I agree, and we're seeing that now.
We'll try to avoid that, right?
Indeed. Thank you so much for your time, Alexey Zabotkin, coming from the central bank. I know you've got a meeting at the Duma, and you needed to get away for that as well. So I'd like to express my thanks to you, and then I'm going to just turn the last 5-10 minutes of the conversation to Sofia. But first, thank you very much, Alexey, and I do hope to see you in person soon. Thank you for your time.
It's all mine, and it will depend on the path of the pandemic, as many other things. Yeah, thank you very much.
Brilliant, thank you.
Thank you.
I'm going to take this opportunity, Sofia, because we didn't put in 10 minutes on the schedule to listen to the best economist in Russia. I can say that now the central bank's gone. So I just wondered whether you might want to talk us through, why do you think growth could be 2.5% when all these pessimists out there are looking for, and they might be right, of course, we know, and I'm not, we know how uncertain it is, but why are you looking for 2.5 when so many people are saying 4, 5, 6% declines? Where do you think we might see the positive surprise in Russia in the next 6 to 12 months?
I believe that definitely our outlook, as well as any outlook these days, depends on the path of the virus, which is extremely uncertain. But what we saw just from the beginning of the crisis, that Russia withstand this very shock, probably is more resilient to the shock than some peers, even though it is definitely badly hit from the commodity side. It's still less sensitive from the part of other sectors, given again what I've already mentioned, the larger share of the state in the economy, more robust employment, and even in May, after some additional spike of unemployment, it's still close to 6 percentage points, which is very, very low, I believe. So, and the mix of government measures was skewed toward keeping employment and keeping wages at a more robust level that gives a nice starting point to a recovery of the demand, which we are anticipating to see already in the third quarter of this year. So in the end of the day, we expect that we will see a recovery of domestic consumption, even though we see export at minus close 6 percentage points for this year. The domestic part is still on the stronger side. And it's definitely, clearly, it is supported by quite a pronounced fiscal and monetary stimulus. So though we were talking today about the consolidation of 2001 and 2021, 2022, but before this consolidation, we will see a massive fiscal stimulus filtering to the economy. And this is not just a large stimulus, it's a stimulus which comes after 5 years of quite strict mix of both fiscal and monetary stimulus. So it's like you were starving for 5 years, and after that you get plenty of stimulus, plenty of fiscal thoughts and for growth, and that's probably the key part of our more positive outlook on growth for this year. But I think that to sum up what we've heard about the MinFin and central bank outlook for this year, I would say that after this discussion, I feel comfortable about how MinFin and central bank prepared, equipped to react for current shock, and they still rely on forward-looking approach, which is quite brave, I think, that during this testing time. And we see no risk for sustainability of the fiscal position and solid rating outlook. The fiscal stance going to neutral and go back to the fiscal rule in coming years. That probably will give us a combination of about a little bit more strict fiscal policy in coming 3 years versus more prolonged monetary easing. That together with the growing quality of corporate management and the fact that the MinFin sticks to its privatization plans and sticks to its high 50% dividend payoff strategy for state-owned enterprises, that probably is quite a good news for equity investors in the national market.
I think any dividend offering more than 1% on US Treasury yields is going to be interesting, particularly on a currency that's not expensive, like the ruble. I think you were making the point some months ago that Russia was also lucky this year that the big national projects, the big spending of 2019, had actually arrived a bit late and was more likely to be lifting 2020 GDP growth anyway. So in a way, some of the stimulus was actually a delayed lag from money that should have been spent last year, right? And that's been somewhat supportive. I know we've got some great sessions on oil and gas coming up from Alexander Bergansky later over the course of this week. I'm still struck by the point he made to me a couple of years back, that even when the oil prices were crashing in 2014-15, Russia continued to drill new oil wells. Companies don't entirely stop new exploration just because the oil price has gone down. The whole process is such a long-term cycle. They have to take the down bits of the cycle and still do some investing. So I'm just curious about how that feeds into what you think investment's doing this year and next year, what you think household consumption's doing this year and next year. So if we break down the GDP figures, what sort of percentage changes are you looking for households, government investment?
Surprisingly, for this year, we have quite a gloomy forecast for both investment and consumption. So we have consumption at close -5 and investment at close -10 for this year. But it's compensated by a lower demand for import. So what we will have on the side of a consumption for this year is that Russians could save up to $30 billion by not going abroad for the summer season. So it could provide an additional boost for domestic consumption. So we clearly see that the structure of consumption is changing. So the share with a decreasing share of services and decreasing share of import toward the higher share of domestic consumption. So, and I think no wonder. So it's not quite surprising, but still, but in the end of the day, definitely will be more supportive for domestic versus import consumption. And as for investments, clearly with such a high level of uncertainty, there is such a challenging time for making any kind of investments. So the widespread of the effect on the economy will be quite, bad in terms of the dynamics of investment. But as you mentioned, unfortunately, we didn't have enough time to speak about national projects with MinFin today. But what we hear from their communication, they repeatedly confirmed that national projects remain the top priority. And even during this quite a challenging period, they almost goes as planned, with some redistribution, but not major, toward our expenditure, but not major. So this could be quite a driver for investments in terms of infrastructure, probably some green investments, which are part of the plan, and so supportive for construction, both for this year and for the next year. So in 2021, we expect to see a rebound in both the consumption growth to closer to above 3 percentage points, and in investments of around 7 percentage points for the next year, which is the highest level in 5 years.
And largely financed by the Russian banking system, I'm guessing. I mean, although dollar funding costs for corporates is about as low as it could be. So I guess that Eurobond option is still open for Russian corporates, and that may well be very attractive form of financing. But the Russian banks themselves are going to be helping finance that investment, or is it more domestic profits that you think will be financing the investment?
So in terms of the banking sector, I think there's quite a room for growth of credit and for rebalancing the portfolio. What we see now is that, again, the fiscal stimulus will filter into the economy, creating more liquidity that will give room to easily absorb both additional supply of oil zats, which is planned for this year, which could increase to around 3 trillion rubles net for this year. But not only government debt, but also corporate debt. So, and we see quite a strong, I believe, interest, quite sustainable interest from the side of our external investors toward Russian debt in terms of Eurobonds. So I believe that both in terms of financing through external market and domestic market will be an option for Russian corporates this year. And again, especially given such a low level of both domestic and external interest rates.
And can I just ask, as you kind of your experience with the virus over the last few months and kind of how Moscow is feeling about it, or what you're hearing from friends and so on. The easing of the restrictions in Russia, we're getting that easing happening in the UK, and there's a lot of people nervous about it. A lot of people are impatient and want the restrictions gone as quickly as possible. So there's a big range, but I think there's a lot of nerves in the UK. And certainly it's been curious to watch it happen in the States in two completely different ways, in the Northeast where the virus has come down. I'm just wondering, what's the mood in Russia? And I know it's, what's the mood from the people you see about the restrictions and how the virus has been looking forward?
I believe that for now, we are exiting quarantine in such a fast pace. It was quite, it was unexpected. And probably it is something to do with the preparation to July the 1st. So our referendum, so more people should be happier to see these changes. I would not rule out a scenario where we see additional restrictions back after July. Just because for now we don't have a consistent decrease of cases. But we strongly believe that any kind of a second wave, both domestically or globally, won't trigger as strict restriction as we saw in April. So we clearly see that we passed the lowest point in terms of the contraction of economic activity in April and May. So we believe that this is our base case scenario. So whenever it's happened, both domestically and globally in August or September, that won't be that bad. But on the other hand, we still see that even with removed restrictions, people are staying a little bit cautious about going back to normal. And this is probably the thing that will affect the pace of a recovery especially for services.
Sofia, thank you so much. And thank you all of people, anyone who's dialed in and has still managed to get this last bit of the conversation. Thank you very much for joining this hour. I hope you enjoy the rest of our conference. And I will, yes, just thank you once again, Sofia, for stepping up there for the last few minutes. Cheers. And take care, stay safe and all of that. Take care. Bye-bye.
Thank you, everyone. Have a nice day. Stay safe, stay healthy.
Бизнес – это риски. Выявлять риски и эффективно управлять ими помогают решения Интерфакса. Создавая эти сервисы, мы опираемся на наш опыт работы с информацией, знание потребностей клиентов и качественный контент. IT-решения Интерфакса преобразуют информацию в знания. Они помогают нашим клиентам вовремя принимать решения, снижать риски и расширять деловые связи. Интерфакс – IT-системы для бизнеса.